Hi everyone, welcome to Investing Club. In this video, I'm going to be answering the question, is value investing dead? And this has been a question that has been brought up a lot recently, and I will tell you the answer right now. Spoiler alert, it's not dead. Okay, you heard it from me first. But in this video, I'm going to be talking about specifically why growth has outperformed value in the past decade or so, and why, in my opinion, that is about to change. Be sure to hit the like button for the YouTube algorithm, really helps out my channel, and now let's get right into the video. So I think first it's important to provide a little backstory about what value investing really is and where it started. So the father of value investing was this person named Benjamin Graham. And he was the person who invented value investing. And he was an investor in the early 1920s that came up with this method of analyzing stocks to find out which kind of stocks were trading at a discount to their value. And value investing has changed since then, but the original way of value investing was just to look at the company's liquidation value and their assets, and to see that if a company was trading below the amount of cash they had, then that would be considered an undervalued company, and you could buy it and expect to make a good return. And this is the specific strategy that Ben Graham used. It was called the net, and that is where a company is valued based solely on its net current assets. So this is the example of, a company selling for $5 a share and they have $10 a share in cash. Then obviously something's not right. The stock is being mispriced. And back in the 1920s and 1930s, there were so many of these stocks because no one was doing this method. And so you could easily buy a basket of 50 or 100 of these stocks and you could easily outperform any index. And even though this isn't what most value investors do today, this is something that still works. We can take a look at this portfolio, and this is a portfolio that models the strategy of Ben Graham, which uses the net method. And what you can see is since 2003, this value portfolio has outperformed the S&P 500. So I think that's a super important thing to note, that if you do this for a long period of time, which long period means more than 10 years, ideally 20 years or more, then value, the vast majority of the time, outperforms. And what you can see is since 2018, this value portfolio has been lagging the overall stock market, and it probably has since 2009. Okay, and there's a good reason for that, and I'm about to get into that later in this video. Now, first, we can talk about what has changed in value investing. Like I said, back in the 1920s, value investing was easy. You could find a stock that was trading below its book value, below the amount of cash it had, and then based on that, you could find the value of the stock and buy it. But the question is now, that's way too easy. Now, with every online screener you have, everyone knows what stocks are trading below the amount of cash they had, and so everyone can do this. So now there's not as many opportunities that were as obvious as there were back then. So now value investing is a little different. Now, instead of valuing the company based on just the amount of its current assets, Warren Buffett took this idea and changed it. He started looking at companies based on the value of the current assets they had and the amount of cash that the business would generate over its lifetime. And that is sort of the new version of intrinsic value that most value investors use now. They estimate the amount of cash that a business will generate over its lifetime, and that is the value of the business. And this is a very important chart in my opinion. This shows US stocks value versus growth and their relative performance all the way back from 1926. And so when the chart increases, it means value outperforms growth. And what you can see from this chart is over the extremely long term, this chart almost goes back 100 years, you can see that value vastly outperforms growth, right? Historically, value stocks always outperform growth stocks over the very long term. And so even though this line has been steadily increasing, what you can see is over the last 10 to 15 years, this line has been relatively flat and going down. So what does that mean? Over the past 10 to 20 years, growth stocks have been outperforming value stocks. And what is the reason for that? Well, this article points out four main reasons. First is mean reversion following a decade of underperformance. From in the 1990s to 2000, growth stocks were vastly underperforming value stocks. And so in terms of mean reversion, which is something I talk about on this channel, it's common sense to assume that at some point, growth stocks will make a comeback, revert to the mean, and start to outperform value stocks, at least for a short while. Second is low valuations relative to growth stocks. So again, that makes sense. Third, rising interest rates forcing investors to focus on fundamentals. So even though this doesn't apply as of March, interest rates were cut back to zero, they were slowly going up over the past couple of years. And if we see that trend continue, then value stocks will likely benefit from that as growth stocks will no longer be able to be valued as highly as they are. And fourth, consistent overpricing of growth stocks due to this behavioral bias, which is something we see way too much. You see a stock like Tesla go up 200%. You see a stock like Zoom go up 4 times in a couple months. What happens? Everyone starts dumping their money into it because they think it's going to keep going up forever. And obviously that's not the case, but there's this behavioral bias, especially with new investors, that they see a stock going up over the past few years and they think it's a good investment and start throwing money at it. And so those are really four of the reasons why I think value stocks are poised for a comeback. Now, that being said, over the past 10 to 12 years, from 2008, growth stocks have outperformed value stocks by a very significant amount. Growth stocks have been up 365% and value only 221%. And so this has gotten a lot of people saying, well, value investing is dead. Now, why are there so many people saying value investing is dead? Well, on most YouTube videos I see about this topic, everyone in the comments is saying value investing is dead. Warren Buffett doesn't know what he's doing anymore. Now you need to invest in companies like Tesla and Amazon to be able to make good returns in the stock market. And the problem with all of these people is these people haven't been investing for very long and they haven't studied history at all. So they don't really know what they're talking about. All these investors that use Robinhood, the charts on Robinhood only go back 5 years. So when all these newbie investors go on Robinhood and look at their charts, they see the charts of stocks like Apple, like Tesla, like Amazon, like Zoom. Over the past 5 years, what have they all been doing? They've all been going straight up diagonally to the right. And so, of course, when you're just looking at that information, you're going to assume value investing is dead. Growth stocks is the new way to invest. But if you just take a look at the long-term history of value and growth, you would see that that is definitely not the case. I think all you need to do is take a look back at history to show that value investing is not dead, and it is natural to go through these phases of growth outperforming value and vice versa. So right now I'm going to pull up a very long-term historical chart all the way back to 1930, and this is probably the most important chart in this entire video. This chart shows the value versus growth differential. And so when the line is above zero, that means value stocks are outperforming. And when the line is under zero, it means growth stocks are outperforming. And what you can see from this very long-term chart is it's very clear that there are long-term periods where growth outperforms value, and then when value outperforms growth. So going back to 1930, from 1930 all the way to the middle of the 1940s, growth stocks were vastly outperforming value stocks. And then we saw the shift from the mid 1940s all the way to 1960, a period of almost 15 years. It was all value stocks outperforming growth stocks. Then again, for the next 20 years or so, growth stocks mostly outperformed. Then from the middle of the 1970s all the way to almost 2000, which was the dot-com bubble, we saw value stocks outperform. Then we saw during the dot-com bubble, growth stocks outperformed as would be expected. Then from 2000 to 2008, we saw value stocks outperform, and look what happened in the past 10 years. This is probably the most extreme outperformance from growth stocks that we have ever seen, at least for the last 100 years. And so for people saying value investing is dead, I would just tell them to take a look at this chart. For me, it was pretty obvious that this was going to happen. If you take a look from the 1970s all the way to 2010, value stocks have been vastly outperforming growth stocks that entire time. Most periods besides the dot-com bubble, it was value stocks were the way to go. And so if you looked at this chart up to 2008, it would be pretty obvious to me that growth stocks would make somewhat of a comeback just because of that concept of mean reversion. So now, what does this mean right now? Value versus growth follows this historical pattern, and I think it's pretty obvious where it's going to go next. It's probably not hard to see from this chart. You could show this chart to any 5-year-old and ask them where the line is going to go next, and most likely they would point to the line going up, which would signify value stocks outperforming growth stocks. And so that is fully what I expect to happen. And so I think this is probably one of the best times in history to start owning value stocks. And that is just my opinion, but I expect a huge rebound in value stocks that will result in them outperforming growth stocks for a very significant period of time, starting it could be starting right now. Now, growth stocks could continue outperforming. I don't know for how long, but once that shift happens, and it will happen at some point, value stocks will start outperforming growth stocks. Now, I said I think this will start a shift from growth stocks outperforming to value stocks outperforming. And so what we've seen is huge inflows of cash from this past March going into value ETFs. And I think that is the start of a new trend that we are about to see. The iShares S&P 500 Value ETF, which is ticker IVE, saw 1.7 billion in inflows in the past month and a net 1.1 billion added in the last 3 months. And I think this is definitely something that will continue as more investors realize these growth stocks really don't have any reason for them to be valued this high, and most investors will start to realize that they may not be going up much from here, and value stocks represent a much better opportunity. And the last point I want to make is that value investing and growth investing aren't two completely different things. They can be the same thing, and you can do both at the same time. Just like you can value traditional value stocks, you can value growth stocks as well. And if you value a growth stock and you buy it below that value, that is value investing. And that is exactly what I've done. This is one of the stocks in my portfolio, NV5 Global. The ticker is NVEE, and this is a fast-growing company. You can see their earnings for the next 5 years are expected to grow at 14%. Like most companies, their growth estimates have been going down, but when I invested in this company, their earnings were growing at 25% a year. And you can see this for next year, their earnings will grow at 26%. And so this is a very fast grower, and despite this, their forward PE is only an 11. So of course that doesn't tell you the full picture, but from the research I've done on this company, it is undervalued. And so you can still find companies like this that are growing at 20-25% a year and buy them below their value. This concept that you either have to be all growth or all value, I think is false. I think it's fairly simple to mesh the two together to use a strategy that will allow you to value growth stocks and then buy them when they are below that value. And I think that really gives you the best of both methods, taking advantage of the growth that is going on in our economy and innovation that is going on right now, along with the safety and assurance of buying stocks under their true value. So that is just what I wanted to talk about in this video. Leave a comment down below what you think. Is value investing dead, or will it make a comeback? If you learned something from this video, smash the thumbs up button, subscribe to the channel where I post videos like this multiple times a week, and I will see you on the next video.